welcome to this very special edition of The Firm, coming to you from the Reserve Bank of India headquarters in Mumbai. In just a few minutes from now, I'll be joined by a man who's about to put to rest all the confusion surrounding call and put options in this country. As you will recall, at the start of this year, the RBI issued a notification saying shares of convertible debentures containing an optionality clause but without any option or right to exit at an assured price shall be reckoned as eligible instruments to be issued to a person resident outside India by an Indian company. But there was a twist in that notification. The RBI has prescribed a new pricing regime for foreign investor exits using call and put options. And while it's not our case that equity should get assured returns, a dual pricing regime can be confusing and in some cases unfair. For instance, in the case of listed equity, a non-resident has to buy from a resident at not less than preferential allotment price. But when selling to a resident using an option, the applicable price is the market price. In the case of unlisted equity, a non-resident has to buy from a resident at a not less than DCF-based valuation. But when it comes to selling to the resident using an option, well, the price has to be arrived on the basis of return on equity in the latest audited balance sheet. Interestingly, for investments in preference shares and debentures, the entry pricing is specified, but the exit pricing can be as per any internationally accepted pricing methodology. So why has the RBI created a dual pricing mechanism? Joining me on this special edition is G. Padmanabhan, Executive Director, RBI.
Mr. Padmanabhan, thank you very much for your time and thank you for speaking to the firm. Let me start by asking you why it was not enough for the RBI in its notification or circular to simply state that, look, we will not allow for an assured return. Why did you think it was necessary to impose a new set of pricing criteria, linked to whether it's listed equity or unlisted equity, creating a dual pricing mechanism of sorts?
Well, I think we thought about this for quite some time as to what we need to really put in there. I mean, whether we like it or not, one of the aspects that is happening both in respect of, mostly in respect of the FDI, is that the pricing gets notified by the government and the Reserve Bank of India. I mean, that has been the rule always. So at some stage to say that the assured return is not there, but you can put any kind of formula there, would have, again, we would be faced with a plethora of questions, whether this is right, that is right, and we would be facing a number of questions. This has been our practice in the past. So we needed to be very clear as to, we give one basic formula based on which the market will be able to take it forward. Having said that, let me also admit that probably the last line on this has still not been written. We want to see how this will impact, how the market will take this forward, and if there are operational difficulties still, let me place it on record that Reserve Bank would be willing to continuously look at it and improve the system. We look for a better indicator, and from our discussions, the best indicator possible was this, where an assured return was not given.
All right, fair enough. And you've been very encouraging in saying that you're open to looking at any suggestions that come in. But when you said that you needed to put in a pricing requirement, because that's been the tradition at Reserve Bank of India, let me ask you this question. You already do have a pricing requirement. When it comes to both the entry and the exit of foreign investment in this country, you have put in a DCF floor for unlisted and a DCF cap for unlisted. Similarly, there are criteria for listed, and I won't list all of that right now. Why is it that that was not enough? Because if you said no assured returns, and if you said that while exiting you cannot get more than the discounted cash flow valuation linked price, you had already set parameters then. Why include a ROE linked price?
I think if you ask any finance guy, the discounted cash flow really cannot be considered as something where an assured return is not being given. In a way, yes, I agree with you. But the problem with the discounted cash flow is the final price depends upon what is the discount factor you put there. And the discount factor could be anything. So whether discounted cash flow is the ideal way of moving forward, in my personal view, probably not. So we had to give a number which probably gave less amount of freedom to interpret at what could be the discount factor, because the next set of problems we could be facing is that we would be faced with a number of questions about what could be the discount factor, how do we know that please remember that we are talking a discounted cash flow basically takes into account the future prospects of the company also. The future prospects nobody knows. And as far as an equity investor is concerned, the difference between the debt investor and the equity investor is that the equity investor has to take the risk as far as the company's performance is concerned. And that is what we have tried to achieve by prescribing the return on equity.
There is no argument with the fact that of course an equity investor must take risk, and there is nothing like an assured return when you're using equity as an instrument of investment. But you have tacitly in a sense admitted that DCF is fudgeable. In that case, the shift from CCI pricing guidelines to DCF, which took place not very long ago, I think barely a year and a half or 2 years ago, in itself comes under scrutiny or under question, because without an option as well, if the DCF cap or the DCF floor is a fudgeable floor or a fudgeable cap, then in that sense the pricing guideline in itself is ineffective to begin with.
There is a slight difference between, while I agree in substance with what you are saying, here we are talking about an agreement or a contract where the investing company is compulsorily forced to write this option.
Sure, I understand.
So this is where we wanted to give some kind of a better arrangement rather than the DCF. Now, if you ask personally what would be my take on the whole thing, I think progressively we should move towards a regime where neither Reserve Bank of India nor the government gets into the question of pricing, and the pricing is decided by the buyer and the seller.
If my audience is here, there would be a loud round of wild applause to that. But unfortunately, we're not there yet, right? Because we now have not just one pricing regime. When we shifted from CCI to DCF, the reviews were mixed. Many people thought CCI was an outdated way of calculating value. DCF, many people said, is of course more contemporary, but like you've said yourself, is a little fudgeable. So they were not clear. They said, RBI can't prescribe discount factors. So does anything go under, DCF as a floor or DCF as a cap? Now that's been further compounded by the fact that you have this curious sentence which says at a price not exceeding that arrived on the basis of return on equity as per latest audited balance sheet.
Right.
This applies to the exit of foreign investment by a foreign investor to an Indian company in unlisted shares. Now,
with an optionality clause.
With an optionality clause, of course. As per latest audited balance sheet, does it have to be the annual balance sheet?
No, we have not said so.
Quarterly or half yearly?
It could be anything. It could be it has to be an audited balance sheet. It could be anything.
Okay. And when you say arrived on the basis of return on equity?
Okay. Now, to explain that, I think we need to understand not merely the letter of the circular, but the spirit of the circular.
Sure.
The problem why the optionality was banned in the first place was that there was a problem between the money coming in through this route, which is really an ECB money, where an assured return is being taken. So we have tried to curb that, and we said the optionality is completely stopped. But then we also will have to realize that we live in a world where we'll have to compete with the rest of the world in receiving this money. So completely stopping optionality, if rest of the other countries permit this optionality, then there would have been a problem. So we wanted to have some kind of a wire media where we ensure that an ECB does not come in through this route, which was primarily the concern why we stopped this, and finding out a wire media. If it is understood in that spirit, then basically what we are saying that an annualized return on your equity with an optionality clause, if your return on equity, let us say for that year of the company is 15%, it can be anything between 0 and 15.
For that year?
Absolutely.
Now, if this is a 5 or a 7-year investment, which is typically how foreign venture capital investments work, and I'm using that subset because that's the subset that gets most impacted by this,
right? We understand
unlisted equity.
Absolutely.
Now, foreign venture capital works between a 5 to 7 year exit, and for them, if the last return for the last audited balance sheet, as you pointed out, is 8%, 12%, 15%, they earn 15% over a 5 or 7 year period, sir.
Right.
You've capped their ability to get a return.
No. Let's be very clear about it. We are not trying to
Is
say
it 15
here
into
that
5 and 15 into 7?
I'll clarify that. I'll clarify that.
Okay.
Now the point is, we agree, Menaka, that a 1 year money, the return has to be less than a 5 year money.
Yeah.
Obviously,
Yeah.
right? So a person who has put in for 5-year money, we are saying that you calculate your return on an annualized basis for this 5 years based on your return on equity of the last year. So if the company has been improving on performance, take higher amount out. We have no problem.
So can you give me an illustration just so that this is crystal clear for everybody?
The illustration, I mean, I'm just talking from the top of my head,
Yeah.
but let me try to say that what I'm saying is that if the company's performance increases over the 5 years, starting from an 8% to 15%,
Fine.
we are saying that the optionality says that 15% annualized for the 5 years, he can take it out.
So that's 15 into 5.
I mean, 15
Technically,
into 5.
I'm putting it simplistically.
Yeah, but
15 into 5.
it is basically meaning that you are getting a return on for your money put in every year at a rate which is the maximum of, if the last year has been the best year, you get a higher return.
I understand that. So the concern was this, that if RBI restricted this to being just the return for the last year, and in the previous illustration that we spoke of, if the last year's return was 15% and all the investor was going to get, the foreign investor, was 15% over a period of 5 years or 7 years, then that did seem to be unfair.
Which basically goes back to the point that what we are trying to conclude, if that had been the rule, and God forbid Reserve Bank never thinks that way, is that a 5-year money and a 1-year money should get 1 year return.
Exactly.
We are not trying to say that.
Okay. So you are saying that you will get, if at the 5th year, and which is the year of your exit, the return was, as per the last audited balance sheet, 15%, you'd get 15 into 5, simply put.
I mean, I'm not talking about the numbers. You get an annualized return. That's the technical way of putting it, at the ROE basis as per the last audited balance sheet. So if it is 15%, it's 15% and for 5 years.
Yeah, something it's X into 5,
Yes.
whatever that return is. All right. Will this be capped by DCF in any fashion? So that's the other question that came up, that you have for the exit of foreign investment a cap of a DCF valuation. Now if you're exiting using an optionality, you have the linkage to a return on equity. Will whatever you get from that return on equity linkage, which in our case is 5x, will that 5x have to be less than the DCF valuation?
See, please remember we are dealing with two sets of contracts, or even in our view, two sets of instruments. One instrument which is a pure FDI instrument where there is no optionality built in. Here we are talking about an optionality built in. Again, I have explained to you the background for this. And when an optionality is getting built in, that is based on only the provisions of this circular and not beyond this. So the DCF does not come into the picture at all.
So if you're exiting using an optionality, then there is no DCF cap that applies to you. That's the simple takeaway.
And even the other way around. If you are not exiting using this optionality, but this optionality was built in, you cannot force the investor. Then it becomes what, as if you cannot force the investor. You cannot have a contract there stating that I will have the right to say that either I will use the option or we will use the DCF method if I don't have the option. Then the purpose of issuing the circular is defeated. So
you can't arbitrage between the two.
Absolutely.
Is what you're saying. Now you answered my next question already before I ask it, because this is what came up in several conversations, saying if the ROE based rate of return was not, or the ROE based price was not working out to the advantage of the foreign investor, and that could happen. Businesses go through ups and downs. One can't envisage every single situation in advance. Then can the foreign investor let the option be cancelled or lapse or etc. and choose to exit not via an option and thereby use the DCF valuation criteria as a cap?
Okay, let me try to probably edit my earlier answer and say that that cannot be a part of the contract. You cannot say that if it is not there, then the promoting company has the obligation to use any other DCF method or whatever method. Then the investor company goes back to a situation where as if the options did not exist. So whether he sells it to the investing company, the investing company will have to be agreeable to buying this. He cannot force the investing company.
Of course.
Here we are talking about a case where the investing company has an obligation to do this because he is technically writing an option. and those are the cases that are covered under this circular.
Okay, fine. So you've made that crystal clear as well, that you can choose to exit not using the option as long as the investee company is not forced to provide
Absolutely.
you that exit.
Absolutely.
Right? That's but
right.
it's fine by you.
Yeah.
So I don't know how RBI will even check all of this, because how are you going to check what's written into a variety of these agreements? So where will you be able to monitor all of this?
Well,
anything can go.
Yeah,
right?
can I answer that?
Yes, please.
I think Reserve Bank, honestly, this country will have to move towards believing that we would be facing a society which believes in compliance. So if the Reserve Bank has to police every contract that is written between the investor and the investee company, that is just not possible. So whatever cases that we got on based on which all these developments happen were those cases which came to us for compounding.
Right.
Because at some stage it got caught, they said it's not as per the FDI policy, that came to us for compounding, and that is where all these policy changes happened.
Fair enough. So you've clarified a lot of this pricing confusion, and thank you very much for that. But there's one issue I think that's still bothering many people, and that this circular is not prospective. So it applies to all contracts that have taken place so far, including before the date of the circular. Now, I can see your logic, but what transaction lawyers tell me is that lots of foreign investors had not anticipated exiting at a return on equity linked price, and now they have no option but to do so. In many industries, that would put them at a serious disadvantage.
No, probably the right way of looking at those things is that if you had written an optionality before the circular was issued, after it was banned in 2007, that was not a valid contract at all. Because we said that's not an FDI compliant instrument. So what we have tried to do is actually an exit route. What we have said is that if there are any existing contracts, in fact one of my lawyer friends talked to me when the government notification was issued, actually alerting me on this, that if you could give them some exit option of the existing contracts as long as it is corrected to comply with these norms, then it would be a better way forward, and that was what made us put that sentence in, that could even take care of the existing contracts. Otherwise, the existing contracts, the only way that could be taken to its closure was removing this clause, getting it compounded, and then taking the matter forward. In fact, we thought we had given an exit clause and the market should be happy about it.
All right, well, the market should be happy about it. You have also included one more pricing requirement, and this is in the case of preference shares or debentures, where you have said that the exit by foreign investors via using an optionality from preference shares or debentures should be at a price worked out as per any internationally accepted pricing methodology at the time of exit. Now, that's being read or interpreted by many as a more liberal stance of the RBI, because for unlisted equity, you put in a return on equity linkage. But for preference shares and debentures, so CCPS, CCD, there is no such linkage, and they have the option to pick from whatever international pricing method that they like. The view then is that most foreign investors will prefer to enter and exit through CCPS and CCD as opposed to unlisted equity, because that gives them much more flexibility.
See, Menaka, I think let me be very clear that Reserve Bank never targets a particular product or anything when we frame our guidelines. These internationally accepting norms is the first step towards what I was telling you, that Reserve Bank should progressively get away from deciding what should be the pricing guidelines. Any internationally accepted norm should be the norm for any type of product. But that's a path. So we have started on that path. Today, if that gives a better product profile to CCP, then so be it. But then we will progressively move towards a scenario where the mandating the pricing guidelines is something that we will be progressively trying to get away from.
Mr. Padmanabhan, on the one hand you say when foreign investors enter the country, and again I'm sticking to unlisted equity in this case, when they enter the country DCF is a flaw, which means that you're using a futuristic price mechanism to determine the value of your investment while coming in. When they exit, if they're using an optionality, you're using ROE, which is historical, right? That's what you've put down for unlisted. So it's terribly prescriptive for unlisted. And on the other hand, for CCPS, CCD, you said that you would like to move to a more liberal regime. Isn't this contradictory in one
no,
very...
One is a compulsorily
itself?
convertible, right?
I know. So
the other is an option to take out. So why that is more restrictive is exactly because of the concern that led to our, again go back to the point which we discussed in the beginning.
But it's also CCD, CCPS using optionality. So if it's going to get converted into, you have created now two mechanisms for unlisted equity and a very different mechanism for CCPS, CCD, which is also using optionality.
But where is that optionality coming in as far as CCP?
Mr. Padmanabhan, I'd like to now come to the third instance, right? So there is the exit of listed equity, and we'll come to that later on in the show. The exit of unlisted equity, which you've spent quite a bit of time clarifying on how it will work. And then the exit of a foreign investor using an optionality via preference shares or debentures. And in that case, the RBI has given a considerable amount of I would say leeway or latitude to the investor to determine the price worked out as per any internationally accepted pricing methodology. The broad view is amongst most lawyers and investors that most foreign venture capital investors especially will prefer to come in via CCPS CCD and exit via CCPS CCD because that gives them a lot more sort of latitude in determining pricing as opposed to unlisted equity where you put in several restrictions.
Right. As I said, I think this is just one stage before we make all the instruments based on internationally accepted pricing norms. We wanted to address the issue of the FDI having these options unlisted company first separately because there were a lot of problems with that. We have addressed that. We are in discussion with the government, obviously, to make this pricing guidelines uniform across. So it's a matter of time before this uniformity sets in. I agree that as of now there is a little difference between what is there for the CCDs and CCPS, but it's a matter of time, I hope, before we will be able to have uniform pricing guidelines across all instruments.
So you said you're in the process of unifying, so I just want to make sure you want to convert CCPS, CCD to ROE based as well, or you want to convert unlisted to internationally accepted pricing.
Please remember that Reserve Bank, the way forward, at least as far as the FEMA guidelines are concerned, is to liberalize. We don't go back to a more regimented or stricter kind of calculations or the formula. So these are two separate regimes as it exists today. You would also know that there is a lot of work taking place. Government and Reserve Bank of India are looking at revamping the entire FDI guidelines to make it simpler. So today the problem that has cropped up is these are two different regimes, and these two different regimes, as a result of which two separate pricing guidelines apply. So our idea is to make this all uniform as quickly as possible. The work is on. When that will be completed, I do not know, but it will be very quickly, I hope. But having said that, the specific answer to your question that whether it will be more strict or liberal, it will be towards further liberalizing.
And I'm sure that will be applauded across the board, sir. But currently we've got a situation of product arbitrage because in the case of unlisted equity, the foreign investor is forced to enter based on DCF, which is a futuristic valuation, and exit if he's using an optionality based on ROE, which is a historic valuation, right? That on the face of it seems unfair. But to go beyond that, based on the clarifications you've given me, if he was to not use unlisted equity, and if he was to use CCPS, CCD, he's free to adopt any pricing guideline or any pricing methodology that's accepted internationally. You've created product arbitrage at the end of the day, haven't you?
Yeah, but there is product, the way in which the FEMA has worked and the markets have developed in this country, there is a product arbitrage in several other spheres as well. It is not relating to this particular circular.
Why would you do that here? Is there a reason or a rationale?
The point that I am trying to tell you is that we recognize that this difference is there and we are trying to work towards harmonization. and we hope that this harmonization will happen very quickly. Now, it's a question of waiting till this harmonization happens before we clarify and issue the circular. We could have waited. But we thought, having decided on this, which was a fairly straightforward regime, introduce this and work towards harmonization.
So, but, and much as I want to believe you, for every single instrument there are multiple pricing situations. So I'll go to listed equity now, which we haven't discussed at all. All exits from listed equity seem to now require to be done on the stock exchange. That seems to be the first implication of this notification. Secondly, you have said that if they're done on the stock exchange, they have to be done at market price, obviously. But the entry into listed equity might also draw the preferential allotment pricing guidelines of SEBI. So even there is a difference. The pricing methodology you use to enter, the pricing methodology you use to exit. How does all of this reconcile with the point that you're making, that we want to move to simpler, more liberal regime?
Yeah, first of all, let's try to understand this. We have never said, or it is not to be interpreted out of the circular, that the listed shares, it has to be exited only through the stock exchange. We have not said that. We are here talking about only the pricing guidelines.
At the market price determined on
Correct.
the floor of the recognized stock exchange.
Yes, there is a price which is recognized,
but if it's
and
to be
that price
determined
will have to
on
be
the
taken.
floor, then the only way to determine it on the floor of the stock exchange is to trade it on the stock exchange. So there's no other way to determine a market price on the floor of the stock exchange. You could have said at the last closing price or something like that. It doesn't say that. The language seems to imply that you want all of these transactions to be done on the floor of the stock exchange.
At least that was not the intentions when we were discussing this. If this circular gives that impression, we would look into this and see whether any clarification needs to be issued on that.
Okay, so that's one point. But with regards to, again, here too, the entry price methodology, valuation methodology, is different from the exit price valuation methodology, because the exit price has to be market price, whether it's on the exchange at that point in time or the previous day's closing price. Again, we've created duality there. So my point is, for listed equity there's duality, for unlisted equity there's several different situations and scenarios, and for CCPS, CCD there's product arbitrage. How does all of this reconcile with the RBI's position of let's simplify, let's liberalize, let's treat investors as adults?
Your question is perfectly valid. I'm not disputing the aspects that you have brought out in your question. The point that I'm trying to tell you is that this circular, the Reserve Bank of India through this circular has not attempted to completely rationalize the pricing guideline. That process is on, and very soon we would be coming out with whatever harmonization is possible to make things easier. The only thing that we attempted through this circular was to make sure that this optionality issue was taken care of. We know that there are different regimes there. That is where I told you ab initio that what we are trying to do is to harmonize. So the fact that we have moved a step forward, it doesn't mean that we have reached the finishing line. We are conscious of that. But please give us credit for that.
Absolutely, sir. And look, I don't think that there can be any argument against the stance or the position that the RBI has taken that you cannot get assured return, right? Because if you do, then it's debt, it's not equity. Nobody can argue against that. But what we have in the process are an interim set of guidelines that till you don't fully harmonize all your pricing guidelines will be operative. And since they're operative, whoever exits between now and your final guidelines coming out stands to be disadvantaged at some level, through what is happening here, or definitely confused and perplexed, and in some ways those who want to enter may look at this and say, well, I'm not really sure how I'm going to exit, what will apply to me at the exit, this is all sort of wheels turning, so maybe I'll hold back.
So look at it from a slightly more positive side. Now suppose there were these contracts which were existing despite whatever we had banned with this optionality, and we know that those contracts were existing. Do we keep that open-ended and through the compounding route forever? Or do we take an interim decision, because other things involves multiple regulators, multiple discussions, we need to take several issues on board to clean up the whole thing. Now that process has been initiated. So this is stage one. So if we say that Reserve Bank should have gone to A to Z and A to C was not an interim which is acceptable to market, that's fine. I mean, that's a view that the market can take. But Reserve Bank in its wisdom said that there are several issues which are going around. Let us try to clarify these things and then move forward. Having said that, as I said in the beginning, this is not the final line. If the market thinks that there is a better method to ensure that the assured return is not given, it's not the return on equity, there is a better method. Our consultation with several market participants, this was the thing that came out. Let the markets come back to us. This is exactly what I said in the beginning. We will be able to, only when things go out and people start working with it, the operational issues people start facing, they come back to us. And all those things, we will be taking care, and as we have taken care of in the past, wherever there are operational issues, those will be taken care. But please remember that these things are in a way so technical and complicated that 10 people can have different views, and those different views would be exactly depend upon how he has entered into the contract. So Reserve Bank will have to strike a wire media somewhere, and that's what we have tried to do.
Okay, fair enough, sir. But this brings me to, I think, a grouse that comes up every now and then when we deal with regulations issued or notifications issued by the Reserve Bank of India, and that is, why don't you put these drafts out for consultation?
Okay, the drafts out for consultation
Every
normally we
regulator
do when there is a major policy change, but in this case when we were trying to sort of sort out an issue which was there, if we had put out this as a consultative paper, then if we receive 100 different opinions, then the whole thing gets taken forward or delayed by another 6 months, 1 year. So the consultative thing can be done. This we thought was fair bit of consultation with the marketplace and the consultants, with the consultants who were involved in this, who came to us for compounding. The discussion happened, the discussions happened with the government, and there was a fair bit of agreement that this is a good way forward to start with. We have done it in our
Okay, I'm not going to argue with, yes, you may have got an opinion that this works. I'm just working on the principle of an exposure draft, and the reason why I'm doing that is this issue of call and put options, sir, has now been on the simmer for over a year and a half or two, and it's only in October when SEBI, put out the regulation or the notification saying this will now be termed valid based on the amendment to the SCRA. So what I couldn't get is why all of this could not have been done in a combined consultation fashion between SEBI and RBI with all of those people who are, related to this. Because the recurring response I get from lawyers and investors that I speak to is that India is slowly becoming like in the song, the proverbial Hotel California, where you check in but you can never check out, whether it's the issue of internal accruals not being used by Indian companies investing abroad, or whether it's the issue of press note 2, 3, 4 and 5 not getting recognized by the RBI for 3 years after, the DIPP put them out. It just seems to be the message going out to foreign investors is, look, we'd like your money, but when it comes to you taking it back, we've got second thoughts.
Fine. But one counter question or the counter comment I have for this is that why doesn't people who come to India, including the so-called lawyers and consultants, also take a stance that when you are prescribing certain rules for entry, those rules for entry are complied with? You are giving your own interpretation to the rules, then asking Reserve Bank of India to solve, and when we come out with a solution, there are 10 people who say that this was not the right solution.
Fair enough. I'm in your corner for that because a lot of very aggressive real estate structures is what has triggered this crisis to begin with, right? If it was to be called that. All right. I think that brings us really to the end of this clarification. I'm just going to leave by asking you one simple question, which might be a repetition, but you said you were open to feedback from industry based on which you might consider changing some aspects of this. Would you consider doing away with all these different entry price valuation criteria, exit price valuation criteria, different for listed, different for unlisted, different for CCPS, different for CCD, and try and give us some uniformity?
Okay. I'll answer this question in two parts. One is, as far as the pricing guidelines uniform across the board is concerned, that is the principle on which we are working, and the sooner we are able to come to a solution about this, and that's something on which you please take it on board, that we will be putting out a consultative paper, because that's a major change.
Sure.
As far as the other aspect is concerned, we are completely open. As I said, this we thought was a better way forward. If the market thinks that there are alternate methods where the same, without assured return, the same result can be achieved, but that works in a much more professional and simpler manner, the industry can very well come back to us, and we are completely open to making any changes in this part of the circular.
Super. Thank you so much, sir. And you said that you were looking at harmonizing all pricing guidelines. You want to tell us the scope of that and what the timeline for that is?
Well,
because that will be the next big story then.
That's a question which even my governor doesn't ask the answer to, the timelines, okay?
I didn't mean to impose one on you. I just meant to ask, when is it that we can expect something,
Very soon. I mean, advanced discussions have happened. We are in discussions with various stakeholders involved. Let's hope.
So you're hoping to harmonize all pricing guidelines?
We are hoping to harmonize the pricing guidelines in such a way that there is complete, if not reasonable amount of freedom to the buyer and seller, and an external agency like the central bank or any other regulator or the government comes out with what has to be the pricing guideline.
Mr. Padmanabhan, Happy New Year to you as well. Thank you very much, sir, for this interview,
Thank
for
you,
your time,
thank you very much.
and for your candor.
Thank you.